Understanding the stock market. The stock market is one of the most powerful engines driving wealth creation in modern economies. It provides opportunities for individuals and institutions to invest in businesses, participate in their growth, and potentially reap significant financial rewards. However, while the stock market holds great potential, it is also a complex and often misunderstood financial system. This comprehensive guide will help you navigate the world of stocks, understand how the stock market works, and develop strategies to invest wisely. What is the stock market? At its core, the stock market is a platform where shares of publicly traded companies are bought and sold. Companies issue shares to raise capital for their operations, and investors purchase those shares, effectively owning a small piece of the company. These shares represent a claim on the company's assets and earnings, meaning shareholders can benefit if the company grows in value or earns profits. Key components of the stock market. Stock exchanges are marketplaces where stocks are traded. The most prominent exchanges in the world include the New York Stock Exchange NYSE and Nasdaq in the United States, London Stock Exchange LSE in the UK, and Tokyo Stock Exchange C in Japan. These exchanges operate under a structured set of rules to ensure fair and transparent transactions. Stocks. Equities. A stock, also known as equity, represent ownership in a company. When you purchase stock, you are buying a small piece of the company. Stocks come into main types. Common stock provides shareholders voting rights in corporate decisions and potential dividends. Preferred stock generally does not carry voting rights but offers fixed dividend payments, making it less risky than common stock. Stock market indexes. The stock market index tracks the performance of a specific group of stocks to gauge the overall health of the market. Common indices include S&P 500 tracks 500 of the largest U.S. companies. Dow Jones Industrial Average DJIA tracks 30 significant U.S. companies. Nasdaq Composite tracks thousands of tech-focused stocks. These indices serve as benchmarks for the stock market's performance, helping investors measure their returns. Investors. Participants in the stock market are categorized into two main groups: retail investors, individual investors who buy and sell stocks, usually through online brokerage accounts. Institutional investors, large entities like mutual funds, pension funds, and hedge funds that trade in huge volumes, often influencing market prices. How the stock market works. Stock market operates on the principles of supply and demand. When a company performs well or is expected to do well, demand for its shares increases, driving up the price. Conversely, when a company's prospects look poor, demand falls, and so does the stock price. Stock market functioning. A step-by-step breakdown. Initial public offering (IPO). When a company decides to go public, it launches an IPO, offering shares to the public for the first time. An IPO allows the company to raise capital for expansion, pay off debt, or fund other business needs. Investors who purchase shares during the IPO become shareholders. Buying and selling of shares. After the IPO, shares are traded on the stock exchange. Investors can buy shares when they believe a company's value will rise, and sell when they think its value will drop. The exchange facilitates these transactions between buyers and sellers. Market orders and limit orders. Investors can place different types of orders when buying or selling stocks. Market orders: buy or sell at the best available price. Limit orders: set a specific price at which to buy or sell a stock. Dividends: some companies pay dividends, which are a portion of their profits distributed to shareholders. Dividends are usually paid quarterly and provide a regular income stream to investors. Companies that pay consistent dividends are often considered more stable investments. Capital gains. Capital gains occur when the price of a stock rises above the purchase price, allowing investors to sell at a profit. Conversely, capital losses occur when the stock price falls and an investor sells at a loss. Capital gains are a primary way investors make money in the stock market. Types of stock market investors. Different investors approach the stock market with various strategies, and each type has its own risk tolerance and financial goals. Day traders. Day traders buy and sell stocks within the same day, profiting from short-term price fluctuations. They rely on technical analysis, charts, and price patterns to make quick decisions. Day trading can be highly profitable but also carries significant risk due to rapid market movements. Swing traders. Swing traders hold stocks for a few days to weeks, capitalizing on expected short-term price movements. They often use technical and fundamental analysis to time their trades. Long-term investors. Long-term investors buy stocks and hold them for several years, betting on the company's growth and long-term value appreciation. They focus on the company's fundamentals, such as revenue, profit margins, and market potential. This strategy typically carries less risk compared to day trading or swing trading. Value investors. Value investors, such as Warren Buffett, look for stocks that are undervalued by the market. They believe that these stocks will eventually rise to their true value and offer higher returns. Value investors often focus on companies with strong fundamentals but whose stock prices have been beaten down due to temporary issues. Growth investors seek companies with above-average growth potential. Even if their stocks are trading at higher valuations, they invest in companies that are rapidly expanding or have disruptive technologies that could drive future growth. Stock market strategy. Yes, there are many strategies investors use to achieve success in the stock market. Some are based on short-term movements, while others focus on long-term value. Here are a few common strategies. Buy and hold. This long-term strategy involves purchasing stocks and holding them over many years, regardless of short-term market fluctuations. Investors following this strategy believe that, over time, the stock market will generally rise, and so will the value of their investments. Dollar cost averaging. DCA involves regularly investing a fixed amount of money into the stock market, regardless of the stock's price. This strategy helps to mitigate the effects of market volatility by purchasing more shares when prices are low and fewer shares when prices are high. Index investing. Index investors buy shares of index funds or exchange-traded funds ETFs that track a specific stock market index, like the S&P 500. This strategy provides diversification and is considered a safer, lower-cost option compared to actively managing individual stocks. Dividend investing. Dividend investors focus on companies that pay regular dividends. By reinvesting dividends and buying more shares, investors can build a growing passive income stream over time. Growth versus value investing. Growth investing focuses on companies that are expected to grow at an above-average rate, even if their stock prices are currently high. Value investing focuses on companies that are undervalued by the market, with the belief that they will rise to their intrinsic value over time. Risks of stock market investing. While the stock market offers great potential for wealth creation, it also comes with inherent risks. Here are some key risks to be aware of. Market volatility. Stock prices can fluctuate wildly due to factors like economic data, political events, or global crises. Volatility can lead to short-term losses, even for fundamentally sound companies. Company-specific risks. Individual companies can face challenges such as poor management, declining profits, or legal issues. Investing in a single company exposes you to these risks, which is why diversification is important. Economic risks. Broader economic conditions, such as recessions or inflation, can negatively impact the entire stock market. For example, during a recession, businesses may struggle to grow, leading to lower stock prices across the board. Liquidity risk. Stocks with low trading volume can be difficult to buy or sell quickly, which could lead to losses if you need to exit a position rapidly. Emotional risks. Investors often make irrational decisions based on emotions like fear or greed. Selling stocks during a market crash or buying during a bubble can result in significant losses. Conclusion. The stock market offers incredible opportunities for those willing to learn and develop a disciplined approach. Whether you're a novice or an experienced investor, understanding how the stock market works and implementing sound strategies can lead to financial success. By following best practices such as diversification, long-term investing, and staying informed, you can maximize your potential while minimizing risks. With the right knowledge, patience, and strategy, you can confidently navigate the stock market and grow your wealth over time.